This weekend, we have a strong pipeline of webinars for you to attend. The first one is corporate bonds versus government securities, where we will talk about where you can focus your debt investments. The second one is how to stay calm and invested during uncertain times. The third one is for the ones working from home, where we will guide you in how you can use your savings to build a high quality mutual fund portfolio. The fourth one is where we will look back at 2024 to see how the global markets have performed in comparison to the Indian markets. And we will also look at what are the new opportunities for investors to invest in the coming year. So if you are interested in any of these, click on the description below to register now.
Hi everyone, welcome back to our session series Talking Straight with Mr. Shyam Sekhar. So in this session, I have few thoughtful questions lined up for him, and without further ado, let's start. So if you had to start from scratch today without having any wealth or reputation, what would your focus be and how would you start it out?
See, anyone who begins has to have an income. So the first step would be to create a reasonable income, and you have to live within that income. When I say live within that income, it means live well within that income. Let's say you're earning 100 rupees. Ideally, I would like to live at 35 or 40 rupees, right? So that I have the capacity to save more. Which means that the lifestyle is set at a level at which you live decently and you save actively. And the saving should be invested in a place where it can grow at a decent clip. So aligning these three requirements would be the first step. Create income, live within your means, and save and invest decently. So these three things are essential. That is the starting point. And this is not going to change anytime. It's universal. So anyone who is at the starting line must get these three things right.
So sir, it's like you have been investing for almost like 3 decades plus. So in this investing journey, what is the one mistake that you regret on, or let's say for example, that created a big life lesson for you for all these years?
See, I think one of the things that you face in your early years is that you want to prove that you are able to find more ideas. It's very natural. So you would have found numerous ideas in your early years. When you find numerous ideas, you allocate less money to your best ideas, first point. That is one thing that always happens. The second thing is you sell too soon because you want to allocate money to a new idea. So these are two things that always happen to every investor in his early years. I feel that some of the companies which I sold, if I had just kept the profit as shares, today it will be worth much more than probably my whole portfolio. So it's something which one could have thought about, but I ended up selling the whole thing rather than retaining a small part. So I think if you say, what is it that I regret? It's probably this thought process of experimenting a lot and not retaining.
So it's like, as you said, as you started early too. So right now I'm in my 20s. So I have been investing my mutual funds and so on. So it's like one question that strikes me all the time is, right now I'm earning so and so amount, and maybe my commitments are also high with education loans and other things. Is it fine I start delaying my investing so that once I have a better pay, let's say 5 years or 6 years down the line, I can invest and save aggressively?
No, I think that should not wait. That habit has to form early. Most people have this thinking that let me get settled and then later I will do investing. It doesn't work that way. Because by the time they get settled, they have not developed an investing habit. It takes them much longer to develop that habit. So the other habits which they have formed early tend to come in the way of investing correctly, investing enough, and investing for adequate time. All these three things get disturbed. The only way you can achieve this objectively is creating the habit on day one. Let's say you're earning 100 rupees. If you have commitment, you should still be able to set aside a 10 rupees or a 20 rupees. So that will help you form the habits. And these habits will get reinforced by time. So when you earn money above your expectations, or when you are adequately compensated to give you a lot of savings in absolute terms, the habits would have formed correctly and you will seamlessly fit these monies into those habits. So forming the habit is a primary real need for every investor. Postponing that habit formation causes a lot of intangible loss for you, and it sets you back by a lot, and you don't actually realize how much it is. So it's better to form the habit and be a part of a certain process than say that I will get settled and then start all the right habits. It doesn't work well in that fashion.
True, sir. So it's like last few years I have started investing in mutual funds. It's giving me decent returns. But I am also part of some friends group and school friends and all. So there is a lot of noise about futures and options. And being that seeing the quick returns at certain point of time, I might also think about it. So it's like, what is the thing or advice you would have for the young investors listening to it?
See, I think what has happened in India is people think that technology will protect them if they speculate, that they would be able to use technology to protect themselves. When I say technology, it is speed of action, speed of transaction, ease of transaction, then access to tools for trading, access to platforms, access to credit, access to capital, access to loans. Seeing all these, people think that there are enough levers in their hand to protect themselves. But when you go and believe that F&O is going to make you rich, you are actually buying into the wrong kind of behavior. And that cost is very, very high. In fact, the damage caused by mediocre investment behavior or bad investment behavior far outweighs the savings gained by technological progress. Behavior is a very expensive thing. And when people go into F&O, I think their behavior definitely deteriorates. They lose the investment character and start thinking of where they can make money every day. Means your vision becomes very narrow, short-sighted, and you start living by the minute, hour and day. I feel that that is the biggest risk, and that is why I feel that an investor should not commit himself to this path. He'd rather be in mutual funds or wherever he is investing for the long term and not going to be affected by any near-term events in the stock market. It's important to protect yourself from near-term events. Like the other day, there was a news on one particular Indian business group. The market fell that day. Suppose you are a speculator and you have to close out your positions on that day. You would have got closed out at a loss. Investors are underestimating the power of these kind of events, how they can catch you unawares, and thinking that everything is manageable. Very few investors are able to keep their speculative activity in check and adequately controlled. It always goes out of control. So, when something goes out of control, you don't end up creating wealth in that, you mostly end up draining your wealth. And I think when you're young, you should be doing something more meaningful than trading in F&O.
So, sir, similarly, what is your take on cryptocurrencies such as Bitcoin or Ethereum? So it's like it is trading at all-time highs. It's like, are we missing out on something, or is it fine to stick with the businesses and long-term growth?
See, I am of the view that while there is a lot of speculation in Bitcoin, it is not yet developed enough user cases. So, if you're saying you're a currency, you should have user cases. Money can buy you anything, but crypto cannot buy you anything, right? So, it's yet to become an accepted currency. As long as it is not an accepted currency, I would be very, very cautious about it, because we don't control the demand supply, and It's a very, very different ball game, right? So I think there should be caution in our approach towards crypto.
So I guess the Indian government is also not that in favor because the taxation also too high for the cryptocurrencies. So what is your take on, should we time the market, or is it like it doesn't make sense if you're just doing an SIP for long term?
See, there are different schools of thought on this. And I don't think any one school is right. Like there are people who say just do SIP, don't do anything else. I am not a votary of that. When the market is really down, you should do more than just an SIP, which means you should do lump sum. When you do that, you are timing the market. When you do SIP, even there, depending on where you are investing, you may be timing a market in a sector. A lot of people run SIP for a very long period, but some people run for 11, 12 months. Suppose you find one theme or sector undervalued and in 1 year you build up the position, then you are still timing the market. And in between, if you find the opportunity to do a lump sum in the same theme and you do it, then you are further timing the market. All this will definitely improve your investment performance. Please understand. Timing the market, if done correctly, can be hugely rewarding. Most investors are lazy to time the market, and most investors don't track the market close enough to time it. They know only a few stocks, what is happening. They are not having an eye for detail. But if you have an eye for detail, then you can do SIP, you can still time the market through lump sums. And I think that is the best way to optimize your returns.
So sir, in this case, what I have also seen in the young investors, we have not seen a big crash rather than COVID. For last 5 years, we have been investing after college and so on. So what I have seen generally is, even if there is a 1% drawdown in Nifty, we go up and invest more, saying it's a great opportunity. Is that a right approach?
So I think the tick size of second decision is basically showing a lot of impatience. People buy a stock for 100 rupees and then at 99 itself they buy double the quantity. So the stock falls to 60, then they don't have a comeback. So this concept of buying more must be done very judiciously, and it should be backed by fundamental research. You should know clearly that the company is doing better and market is not giving it the recognition. Eventually market will give recognition. But if you just blindly buy, saying I like this founder, so I am going to buy because the price fell, you could be the fall guy. You could be wrong. So you should make sure what is creating your conviction in the company and whether that conviction is sustainable. Then you can invest in that particular company.
So you have seen bigger drawdowns like Harshil Mehta case, the 2008 fall and so on. So on this rock bottom journey, what is the conviction that you have when you buy a company? Because we don't know, it's like if it's going to further fall and so on. So what is the thing that goes in your mind at that time?
At times of a market crash, actually your decision making is simplified because the valuation come into a zone of very high comfort. You know that the valuation already factors in bad news. Sometimes it factors in too much bad news. At that point, you flip and become a contrarian and buy those companies. I would still think that those companies can only be bought by people with adequate risk appetite. Most Indians don't have the risk appetite to do it. So that's why they go through institutions like mutual funds and PMS and all that. You can average only if there is a very, very strong case to invest in a company. You can't blindly buy more for others because the value has gone up and because you have made profit, because the other person may end up making a loss also. That is distinctly possible. So you have to be very, very careful when you do this. But I advocate both SIP and lump sum and using them in different contexts according to the relevance, what you want to buy and their valuations. That is what I will do.
Thank you all for listening this session, talking straight with Shyam sir. It's like we would have few more questions lined up in second part. So stay tuned.